Timing is everything with dividend stocks. Buy too early, and you risk dead money. Buy too late, and you miss the payout. But when you understand the dividend clock, you'll know exactly when to strike, hold tight, or walk away. By mastering this timing, you'll stop guessing and start growing consistent cash flow. Month after month, year after year. Part 1. The myth of buy and hold forever for dividends. For years, dividend investing has been sold like a set-it-and-forget-it strategy. Buy quality stocks, collect checks, sleep easy. But here is the truth most people do not hear. Holding dividend stocks forever can wreck your returns if you ignore timing and market cycles. Companies change. Economies shift. A rock-solid dividend payer today can be a sinking ship tomorrow. Just because a company has a track record of dividends does not mean it will survive recessions, industry disruptions, or internal meltdowns. Dividend cuts are warning sirens. If a company slashes its payout, it is usually not just the dividend that is in trouble. The entire business could be bleeding out. Investors who cling blindly to a dividend name because it paid me last year often miss early signs of danger. And here is the kicker. Different economic phases favor different sectors. In a downturn, defensive sectors like utilities and healthcare usually shine. In a booming economy, tech and cyclical companies lead. But those sectors might not even pay strong dividends. Timing matters. Holding forever without paying attention can mean riding a dividend stock straight down through declining fundamentals, lost payouts, and crushed stock prices. Dividend investing is not just about picking stocks. It is about knowing when to hold, when to add, and yes, when to walk away. Next up, we will build your own personal dividend clock, a system to track signals and time your moves like a pro. Part 2. Building your personal dividend clock. Imagine if you could have a clock that tells you not just the time, but when to buy, when to hold, and when to walk away from dividend stocks. Good news! You can. You just have to build it. Start by understanding the rhythm of the economy. There are 4 main phases: expansion, peak, contraction, and trough. Each phase affects dividend stocks differently. During expansions, tech and consumer discretionary stocks might soar. During contractions, utilities and consumer staples become your safe harbor. Next, track macroeconomic signals. Think of these like ticking hands on your dividend clock. Rising interest rates? That could signal we are nearing a market peak. Unemployment rising fast? A recession might be around the corner. GDP growth slowing? Time to start thinking defensively. Your third clock hand is dividend health. Look beyond the dividend yield. Study the payout ratio. How much of a company's earnings go to dividends? High payout ratios combined with slowing earnings? Red flag. That dividend could be on life support. Now, combine all 3 elements. If the economy is strong, rates are low, and dividends are growing, be aggressive. If rates are climbing, GDP is slowing, and payout ratios look stretched, go defensive or be ready to walk. Your dividend clock is not about predicting markets perfectly. It is about stacking the odds in your favor, being proactive, not reactive. Because great dividend investing is not about holding blindly. It is about moving smartly through the cycles. Now, speaking of signals, what macro triggers should you be watching like a hawk? Let's dive into the real-world indicators next. Part 3. Interest rates, the silent dividend killer. When rates rise, dividends die quietly. Interest rates are like gravity for dividend stocks. When they go up, the weight on your portfolio increases, and your dividend plays can sink fast. Here is why. When interest rates rise, bond yields become more attractive. Investors start shifting their money from dividend-paying stocks to bonds, seeking safer returns. This shift reduces demand for dividend stocks, causing their prices to fall. But that is not all. Rising interest rates also increase borrowing costs for companies. For firms that rely on debt to finance their operations or pay dividends, higher interest expenses can strain their finances. This strain may lead to dividend cuts, which can further depress stock prices. Sectors like utilities and real estate are particularly vulnerable. These sectors often carry high debt loads and are sensitive to interest rate changes. When rates rise, their profitability can decline, leading to potential dividend reductions. On the flip side, when interest rates fall, dividend stocks become more attractive. Lower rates mean lower bond yields, prompting investors to seek higher returns from dividend-paying stocks. This increased demand can drive up stock prices and provide opportunities for dividend investors. Bottom line, interest rates are a critical factor in dividend investing. Ignoring them can lead to unexpected losses. By staying informed about interest rate trends and understanding their impact on different sectors, you can make more strategic investment decisions. Next up, the risks of relying too heavily on dividend stocks in an aging bull market. Part 4, Dividend Investing and the Aging Bull Market. Bull markets are amazing for building wealth, but when they stretch too long, they start to crack under their own weight. And for dividend investors, an aging bull market is full of hidden dangers. As stock prices climb and valuations get stretched, the risk of overpaying for dividend stocks skyrockets. You might think you are playing it safe, chasing 3% or 4% yields. But if you overpay in a frothy market, even the safest-looking dividends can burn you. Meanwhile, as interest rates rise, bonds start looking better. Suddenly, investors have alternatives. Money quietly shifts out of dividend stocks and into safer, higher-yield bonds. Dividend stock prices weaken, and if you are not paying attention, your safe income play can turn into a big capital loss. And here is another nasty surprise. During the late stages of a bull market, companies start feeling margin pressure, slowing growth, rising costs, tighter credit. Some businesses will cut dividends to conserve cash right as you are depending on them most. This is why smart dividend investors shift gears in late-stage bull markets. They tighten their standards. They focus on balance sheet strength, low payout ratios, and companies that can defend dividends through downturns, not just during boom times, and most importantly, they stay flexible, because the market always, eventually, turns. Next, we will dive into the psychological traps that cause dividend investors to hold toxic stocks for way too long, and how you can avoid falling into that trap yourself. Part 5. Signs a dividend stock is becoming dangerous. Dividend investing can feel like a safe haven, but even the most reliable-looking stocks can harbor hidden risks. Here are the red flags that signal a dividend stock might be turning dangerous. Number 1. Sky-high dividend yields. A yield significantly higher than the market average might seem attractive, but it can be a trap. Often, a soaring yield results from a falling stock price due to underlying company issues. This could indicate that the dividend is unsustainable, and a cut may be imminent. Number 2. Unsustainable payout ratios. The payout ratio measures the proportion of earnings paid out as dividends. A ratio above 100% means the company is paying more in dividends than it earns, which is unsustainable in the long run. Even ratios above 80% can be concerning, depending on the industry. Number 3. Declining earnings. Consistent drops in earnings or cash flow can jeopardize a company's ability to maintain its dividend. If a company's profits are shrinking, it may need to reduce or eliminate its dividend to conserve cash. Number 4. Rising debt levels. An increasing debt-to-equity ratio can signal financial stress. Companies taking on more debt to fund dividends or operations may face difficulties sustaining payouts, especially if earnings don't keep pace. Number 5. Negative dividend coverage. Dividend coverage, calculated as earnings divided by dividends, indicates how comfortably a company can pay its dividend. A coverage ratio below 1 suggests the company isn't earning enough to cover its dividend, raising the risk of a cut. Number 6. Sector-specific risks. Some sectors, like telecommunications or energy, may have higher payout ratios due to their business models. However, even within these sectors, excessive payout ratios combined with other risk factors can signal trouble. Number 7. Management's dividend policy changes. If a company with a history of stable or growing dividends suddenly changes its dividend policy, it could indicate underlying issues. Pay attention to management's communication regarding dividends. By monitoring these indicators, investors can make more informed decisions and potentially avoid the pitfalls of dividend cuts. Next, we'll explore how to balance between dividend growth and high yield, and when to favor each strategy. Part 6. Dividend growth versus high yield. Timing the trade-off. Dividend investing isn't a one-size-fits-all strategy. The choice between dividend growth and high yield depends on your financial goals, risk tolerance, and the current economic environment. Dividend growth. This strategy focuses on companies that consistently increase their dividends over time. These companies often have strong fundamentals, stable earnings, and a commitment to returning value to shareholders. Over the long term, dividend growth can lead to substantial income increases and potential capital appreciation. High yield. High-yield stocks offer immediate income, which can be attractive, especially in low-interest rate environments. However, high yields can sometimes be a red flag, indicating potential financial distress or unsustainable payout ratios. It's crucial to assess whether the high yield is due to strong earnings or a declining stock price. Timing the trade-off. In bull markets, dividend growth stocks often outperform, benefiting from economic expansion and increasing earnings. In bear markets or economic downturns, high-yield stocks can provide a cushion through steady income, but it's essential to ensure their dividends are sustainable. Key considerations: payout ratios. A lower payout ratio in dividend growth stocks suggests room for dividend increases. High-yield stocks with high payout ratios may be at risk of cuts. Company fundamentals, strong balance sheets, and consistent earnings support dividend sustainability. Economic indicators, interest rates, inflation, and economic growth can influence the attractiveness of dividend strategies. If you've made it this far, I've got a powerful dividend timing guide made just for you, and it's completely free. It includes a simple checklist to help you know exactly when to buy, when to hold, and when to walk away from a dividend stock, plus bonus tips to avoid common traps. Just comment "Dividend Clock" on this video. Once we reach 50 comments, I'll share the link so everyone can download it. Now that you've learned when to buy, hold, or walk away, the next step is knowing what not to do. In the next video, we'll uncover the biggest dividend mistakes retirees are making, and how to avoid them before they drain your income. Don't miss it. This could save you years of frustration and lost cash.